Good morning, folks. Looks like the world is sort of settling down to the Trump tantrums. Markets are a little more stable across the world, currencies, assets, everything. And as far as India is concerned, we have the early bird results coming out for the Jan-Feb-March quarter, which many have been eagerly waiting for. The headline reads, "Early bird results reflect earning hiccups despite margin expansion." So what they are basically saying, about 175 companies also have come in, and that is a sample from which Business Standard is talking to us. Revenue growth has been sluggish with about 8.9% year on year. And what is concerning is that profits are growing at only about 4.1% ex BFSI, and including BFSI 3.8% only. Okay, this is far more sluggish than the earlier quarters. So even though input costs have been rather kind for the last quarter, it has not been good enough. Revenue growth has not been good enough, and hence profit growth is also low. Unlike earlier quarters, what I observe is that the entire sample has shown a growth of 3.8% year on year change in profits, whereas if I take away BFSI, then it improves to 4.1%. It means that banking has brought down the profit margin of the entire pool. So earlier it was the BFSI segment that was keeping up profits and revenue, and this quarter it seems to be that BFSI is dragged down. And by all indications, this could be the trend for the coming year also. Let us see where we actually end up at the end of the year. But number of indicators show that net interest margins would be coming down, whereas revenue growth may not be so great. In spite of the entire segment doing not too good, the ICICI banks and the HDFC banks of the world are still expected to do well and outperform the rest of it within the sector and any other company as a whole. Then inside on the subject of gold, it says allocation, not price speculation, should guide your buy-sell decisions. Honestly, asset allocation is the best answer to whatever issues you have on buying and selling your investments. So here the common question seems to be whether people should add to the gold positions or subtract or begin now. So the article simply suggests that if gold is less than 10% of portfolio, buy periodically or during corrections. So buying during corrections is one of the most difficult things that a layperson can do. So something like a periodic investment pattern like an SIP may work better if you still want to accumulate gold. But the article seems to suggest that if your allocation to gold has gone beyond 10%, you could probably rebalance and get it down to 10%, and in the process book some amazing gains that you have experienced over the last 2 years. And of course, we've had a good surge in the equity markets this week, broadly driven by foreign flows. So equity surge and foreign flows is what the headline is saying. And actually after a period of continuous outflows by FPIs selling and going back to America, the month of March and April have been witnessing better net inflows. So actually over the 2 months we've seen almost 11,000 crore net inflow into equities by FPIs, which is what has been taking the market up, and there's a better optimism as far as the impact of tariffs goes. Now people are more or less convinced that India is in a better spot than most of the world given our lesser sensitivity to exports and hence tariffs. We are more domestic oriented. I think the data has been going around fairly well. The rupee has been pretty resilient, and as we speak it is recovered to almost 83.95, 84 rupees to a dollar after having experimented with 88 just a few days back, right? So this again, I'm guessing because of inflows. What one should remember is that with a stronger rupee, it would have a beneficial impact on our own inflation because we import so much. We import so much oil. We import so much capital goods. I'm leaving gold out of the picture. So if our price of oil comes down, it is going to bring our inflation down. It's already at a low level, 3.6%. Everybody's happy about it. It could come down even more with this. So India would be a beneficiary of crude oil prices falling. And as we know, during the month, it has fallen from $76 to about $66, already 66, 63. It's flirting around in that level. And during the week, also oil has fallen by almost 7%. Because of global growth concerns. As you know, that when global growth is low, the consumption of oil is bound to be lower. So we are going to see softer oil prices unless something radically different happens over the next few weeks or months. Wednesday's Business Standard has a not so happy headline. It says the NSO signals private capex lull in FY26. The NSO stands for the National Statistics Organization Office, National Statistics Office, and they conducted a review with industries and figured that most industries have budgeted lesser for capex this year than the previous year, and it's not down marginally, it is down by 25%. So it was during 24-25 capital investment plans were 6.5 trillion rupees, and industrialists are likely to par the planned outlays for this year by about 25% to only 4.9 trillion. This was first of a kind survey to figure out what the private sector is thinking about as far as capex is concerned. This is not good news, because we've been speaking about the private sector chipping in with better capex outlays. So far it's been the government only that's supporting capex, and every year we hope that the private sector will come in and do their bit, but confidence seems to be low in general. There's a lot of pessimism, so I doubt capex will go up. So this is another reason why banking may not be having such a great time. Banks make their money out of lending money. If there's not so much capex happening, the number of borrowings will be lesser, bringing down their revenue. So that is one of the issues that we are going to be struggling with banking till the economy improves. So there is a lot of data that on key asset classes shining bright in April. So in the month of April, we have seen the Nifty jump by 3.5%. Mid caps have made a comeback with about 4.7%, though small caps haven't. Mid caps and small caps remain overvalued as compared to the long-term averages. So I would take any such revival with a pinch of salt. The 10-year GSEC has prices have gone up and the yield has fallen from 6.59% to 6.36%, and that is because of the known stance of the RBI to be accommodative and dovish, and they have been following up this approach with a lot of liquidity. They're pumping in sufficient liquidity, keeping yields low. Banks should not be complaining with this kind of liquidity because they will always have enough to lend. Okay. The US Treasury yield has fallen by about 4 bips. That's all. There was a lot more volatility in the early part of the month, and it has recovered much of it. Crude, as I said, fell from $76 a barrel to $62.3 a barrel during the entire month, and even the week continued to fall. Gold, as expected, continued to rise up well, jumping up almost 4.91% during the month. Though the last couple of days has seen some profit booking and some correction, and last night the gold futures in the US were almost quoting 2.9% lower. So if investors think that the worst of times are behind us and that there are better prospects for US and China to negotiate a good deal, then some of the chaos comes down, reducing the demand for gold. So yeah, there are many managers who think the price of gold has, at least for now, peaked, and one should be a little watchful about adding positions to gold. And much of the impact of the higher gold prices we've been seeing on Akshaya Tritiya, traditionally a day when Indians go ahead and buy a lot of gold. The demand has been rather muted because of the higher gold prices. Naturally, people can buy much lesser gold for the same money than they could last year or the year before that. And the report here says that in Delhi, the demand was so low, jewelers were able to shut their shop down by 7 p.m. itself, almost 50% of the normal demand, whereas in Bombay it was not as bad. Last year they sold 82 tons of gold on the day, and this year they sold about 62 tons, as on close of Wednesday this week. But it's natural that people would be able to afford lesser gold given the high prices. People's earnings have not gone up at the same rate as gold prices have gone up, nor have their savings gone up at the same rate. So obviously the consumption of gold is bound to come down. A headline here saying large cap funds take lead over small caps in 2-year SIP returns because of the enormous amount of volatility and the sharp fall in mid cap and small cap funds. Large cap funds have taken over the role of the returns leader. Okay, and even now, because of their better valuations, large caps are attracting a larger amount of flows in. So we have seen that the average 1-year return on large cap is 0.2%, whereas mid cap is -7 and small cap is -13. And clearly the large cap is the winner in this period. And also, as a corollary to that, there's some data here saying that Nifty's share in India's market cap is at a 20-year low. Number of reasons. One of the reasons that we used to speak about is the small and mid-cap stocks have gone up so much that the share of the Nifty large-cap companies in the total market cap fell from earlier used to be 80%, and it almost came down to 60 and then came down to 45%. Showing the extent of overvaluation of the large cap and of the mid cap and small cap companies. But there's another interesting bit of data here as to why the share of the Nifty large cap companies has come down, and that is because of the number of companies that have got listed outside the Nifty 50 segment. This is on account of an increase in the number of companies listed on the exchange from 422 in 1996 to 2,720 in FY25. So because we have more companies outside the Nifty 50 index, obviously you're going to see the share of the Nifty 50 come down. So we have two things. One is a sharp rise in valuations of the non-Nifty companies, and then more number of companies being outside. We definitely want more listings because the kind of savings that are being funneled into the stock market, we want more options for investors to buy. And we're really hoping that the Indian economy does good enough that there are more companies to list and more good companies for all of us to buy. That's all, folks. Thank you.